Do you agree? Is it a very decent number?
It's weaker than expected. I don't think it's dramatically weaker than expected, but I think it is consistent with the economy shifting down from very rapid growth 3 to 6 months ago to still rapid growth and still clearly above trend growth, but I think it is somewhat softer. And I think we will need to see gradual further deceleration because we are at a 3.7% unemployment rate. And I think we're probably a little bit beyond the level that's sustainable in the long term. So I don't think there's anything to get super worried about in this report, but it's definitely below expectations.
We had John a month ago, and you said you're very comfortable with our above consensus call for a hike in December and 4 next year. Less comfortable today?
Very comfortable with December, less comfortable with 4 hikes next year. Basically because financial conditions have tightened substantially. I think the data have been a little weaker. I don't think that's been a major shift. You look at the ISM reports this week, for example, they were very good. This one was softer. But financial conditions matter for monetary policy, and if you get the markets do more of the tightening for you, then the Fed needs to do a little less.
And just what we've seen right now, if this is a passing storm, financial conditions, ease up again going into next year, then we're back where you thought we were?
That's right. So the thing about markets, of course, is they move very quickly and they can move a lot and they can also move back. But that's exactly right. If markets go back to, where they were in terms of not, helping growth, boosting economic activity, then of course the downside risks go away.
So when you say, though, this morning you see meaningful downside risk to your baseline forecast of quarterly hikes in 19, what does meaningful downside risk mean?
Well, it means there's a good chance that there will be a pause at some point in 2019, and we haven't had a pause, but I think that markets are, of course, pricing in a lot less tightening for next year. It's basically 1 hike price. Relative to that, I would say that's too low. I feel pretty strongly that it's too low if I look at the whole kind of range of possible outcomes. But the risks to going every quarter are definitely on the downside.
You mentioned the ISM numbers. They've been consistently pretty strong. In fact, they accelerated recently in the U.S. But you have seen this uptick in weekly unemployment claims. There's sensitivity right now to looking for signs of peak type activity and things rolling over. Anything to really scrutinize there?
Well, I think the economy is slowing. I do think it's gone from very strong growth to merely strong growth. So if you're focused on kind of the second derivative of growth, as markets often are, of course, you look at that and you say, yeah, the second derivative is negative. But I think the pace of growth, and in particular the pace of growth relative to potential, is also very important. And that there's still clearly above trend growth. And even this payroll number, even if you took that 155 exactly at face value, you didn't average it with anything else, that would still be above trend.